for joining. I appreciate it. So my name is Amanda Stark. I'm just going to go a little bit, give you a bit about me. So I graduated from Carroll University in 2018 with a degree in accounting. I was a commuter at Carroll, so a bit of a different experience from people living on campus. It was a great experience, but was a commuter. I worked at Ernst & Young for about 3.5 years in the tax private client service group. I did 1040s, family estate planning, partnerships, S-corps, you name it. Started at Vantage Financial earlier this year as a kind of a blended role, being a wealth advisor and senior tax accountant. I have my 7-month-old daughter, as you can see here, and my 2-year-old golden retriever, Finley, and an unpleasant cat. Her name's Kiwi. She hardly comes out of the basement. She hates the dog, but here we are. She's a part of the family. 3 times fantasy football champ. I say this because my husband, Tommy, is jealous that I'm a lot better than him. So he's only won like maybe 1 time. I've won 3. Some hobbies that I have. I love to ski, planning a skiing trip later this year in December. Gonna be going to Colorado. Love music. Subpar golfer. I am not great, but I like to try. And I like photography. So first, we're going to go over some tax basics to make filing your taxes easier so you can save money and plan better. Then I'll also be covering going over a few investing options, how to properly prepare for retirement. So filing your taxes. I'm going to be going over the basics here. I know filing your taxes, anything tax related, can be a bit dense. But if you can take away some of these basics, that's going to be truly beneficial to you. So we're going to go over how do tax brackets work, the flow of a return, standard deduction versus itemizing, additional expenses to include on your return, extending your return, and a tip on your homeowner's exclusion. So tax brackets. There is a common misconception that when you get to a certain amount of money, let's say $70,000, if you're single, you get taxed at this 22% rate. However, tax brackets more so work in thresholds. So from $0 to $11,000, if you're single, you will get taxed 10% on that $11,000. From $11,000 to $44,000, you're going to get taxed at that 12%. Then from $44,000 to $70,000, so a little less than $30K, you're going to get taxed at the 22%. So it's going to go in levels. You're not going to get all of your money get taxed at 22%, but it's going to go in phases. For this slide, my goal is for you to be able to read your return that you prepped with your maybe TurboTax person, your tax preparer, and just, confirm that it's right and it makes sense to you. As you can see here, this is a 1040. This is what you file every year for your taxes. So this portion is the informational section. Socials, addresses, that's the easy part. Then on here, you're going to see your income coming through. Line 1, that's going to be your wages. If you're married, it's going to be your wages combined. You're going to come through here and you're going to get a total income. From there, you're going to have a standard deduction or an itemized deduction, which will bring you to your total taxable income on line 15. This amount at the bottom of page 1, that's the amount that you're actually getting taxed on and what your tax is being calced on, not the income before here. It's the income after your itemized deduction or after your standard deduction. Your total tax is going to flow onto page 2. You're going to have some credits, possibly if you have a child, $2,000 for if you have one child. And then you're going to see your payments right here. Your payments, this is what you pay for. If you say, if you have a job, you withhold taxes, it's not the great situation when you see your paycheck coming in a bit smaller, but at the end of the day, this is where you're going to see that payment coming through. Your total taxes of whether you are overpaid and you get a refund, or if you owe more taxes, that's going to be the difference between this tax calculation here on line 24 and your total amount that you paid in taxes throughout the year. That's going to be the difference that you see coming through on 34 or 35A of what you owe or what you get a refund for. Okay, I know tax forms. Hope you stayed with me there. That may have been the most difficult slide. Hopefully, we'll see how it goes. So, standard deduction versus itemizing. Majority of you will be getting the standard deduction. It was put at such a high deduction with Trump enacting that law that's going to last on for sure until 2025, and it's going to incrementally go up every year. Itemizing kind of applies to if you're more self-employed, if you own your own business, or if you have enough of those costs. So that's going to include medical expenses, dental expenses, interest that you paid on your mortgage, real estate and property taxes, and charitable contributions. Standard deduction, if you're single, it's going to be $13,850, and married filing joint. Again, going back here, you're going to see that coming through on line 12. Okay. So some additional expenses that you should keep in mind when filing your taxes. If you have an apartment, rent paid, that's going to be a credit on your Wisconsin tax return. You're actually going to get $300 for paying rent. So make sure you're including your rent on your tax returns. Home improvements. If you own a home that you've done, let's say replacing your front door. I just did that this year, replacing furnaces, windows, heating and cooling systems. If you got solar panels, that's going to be an energy savings credit. So make sure you're giving that information to your tax preparer. Dependent care expenses. If you have a child who goes to daycare or you have a nanny, long-term care insurance. If you are already getting long-term care insurance, I don't know if we're quite to that point in this age group. Maybe we are. HSA contributions and distributions. Okay. Last slide on taxes. Hope you're still with me here, but these truly are the basics. And at the end of the day, if you can take a few things away for taxes, it's going to be extremely beneficial to you. So extending your return, we're getting close to the point of filing. It's going to be April 18th. You're not quite ready to file, that's okay. You can file an extension for your tax return and you're going to have all the way to October 16th to file that. So you just have to submit the form. It's called a 4868, and that will extend your return all the way to October. One moment here. Sorry, my computer is glitching. Okay. So if you expect to owe, you want to make sure when you file the extension, you send an extension payment with that. That way you're not going to owe any penalties or interest on that. Okay, homeowner's exclusion. This is important to you if you bought a home recently and you intend to sell it. The rule is, so if you sell a house before living it for 2 years, you'll have to pay capital gains taxes on that, which most likely can be thousands of dollars, which is fine if you plan for it. But if you do it without knowing this rule, it could cut into the profit that you intended on making. So pre-plan, if you lived in your home for at least 2 out of the last 5 years, it's excludable if you're single, up to $250,000, and married $500,000. Okay. You got through taxes. Any questions? How are you feeling?
I have a question that kind of pertains a little bit to what I do in the alumni office.
Mhm.
The charitable contributions section, can you
Yes.
explain a little bit more as to the level of charitable contributions you need to make for it to be considered a deduction? Like, is it if I made a $10 gift to Carol,
Mhm.
is that a tax deduction, or is there like a threshold that you have to meet before it becomes applicable?
So it depends on the state that you're in. You're going to want to include those with your return because it can be computed within your itemized deduction on the state side of things. Unfortunately for federal, it was nice in 2021, there was a $600 deduction that you were able to get if you put anything to charity. They stopped that in 2022, so that no longer applies. But basically, the way that itemized deductions work is it has to be over that 13,800 amount in order to be worth your time. So it depends.
Okay, thank you. And that then just to plug the advancement office, some of my colleagues, if you do any kind of charitable contributions to Carol, make sure you track those and, as Amanda is saying, include them with your forms.
Yep. Any other questions, you guys? How are we feeling?
Nothing in the chat as of right now.
Awesome. Okay, so now we're going to go into the financial planning section. And here we're going to go over what's in your control when it comes to retirement and savings. We're going to go through a savings activity, some employee-sponsored retirement accounts, individual retirement accounts, 529 plans, HSAs, and individual brokerage accounts. Okay. So when investing your money, you want to focus on what you personally can control. These things that you can control are savings versus spending, where you keep your assets, and your employment earnings and duration. These next few slides, we're going to go over exactly how to control these few areas to hit your retirement goals. Okay, so this is going to be a little activity, so get out your calculators, your phones, whatever it may be. So this chart shows, based off of your income, what percentage of your income you need to save each year based off of what year you start saving. So for example, if you make $70,000 a year and start saving at the age of 25, then for the rest of your career, if you save that 7% of your salary, you can retire with the same lifestyle that you currently have now. But if you make $70,000 a year and start saving, let's say at age 35, it's not too late to start saving still, but you're going to have to save 12% of your salary so you can retire with the same lifestyle. Basically, what this slide is showing you is that the sooner that you start saving, there's far less pressure on how much money you need to save each paycheck. So if we're going back to the $70,000 a year at 25, you should be saving $4,900 a year and investing that money to be accumulating in your retirement accounts. So everybody just kind of take a second and see what percentage you should invest based off your age and salary and determine if you are saving enough now. If so, that's great. You're ahead of the pack. Saving young is awesome. If not, that's fine. You still have plenty of time to figure out what you need to do to save more. There's plenty of opportunities there. There's different budgeting goals. So, and feel free if you're having a hard time with this calculation, if you want to throw a salary out there. And again, this is current household income. So if you have a spouse, figure it on your total joint income. Or if you're single, figure on your single income. How are we feeling? Any questions on this slide? Hopefully you guys have a better idea of how much to be saving every year. It feels good to kind of have a goal amount to be saving every year. Then you can feel a little bit more confident. Okay, if I'm feeling comfortable where I'm living right now, put that money away and you should be good to go. Okay. So now,
Sorry, I just have a very quick clarifying question.
Yeah.
When you say saving,
mhm,
so here in this example calculation, you have 4,900 per year. You're talking more so investing though, correct?
investing,
Like putting it in a
investing.
401k or something?
Yeah, putting into your 401k, so you're getting that compound interest effect.
Gotcha.
No. Think about compound interest when we start talking about these couple of things. We're going to be talking about more of that later, but the goal is to invest this type of money. Okay. So now we're going to go over retirement accounts. These are specifically employer-sponsored retirement accounts. They include traditional 401ks and Roth 401ks. Traditional 401ks, you contribute pre-tax dollars. So it's pulled directly out of your paycheck with no tax. You put it into your traditional 401k. So the tax benefit occurs when you contribute because you're not paying taxes on that. You can contribute up to $20,500 a year. Most employers have a match. That match is free money. So let's say you put in 5%, your employer matches 5%. That additional 5% is free money that they're putting in. So let's say, going back to our example, you're putting in $4,900. That is 6% of your salary, 7% of your salary. Your employer could be putting an additional $4,000 a year into your 401k and matching that. So that's a big deal. And there's no income limit on traditional 401ks. Roth 401ks, you contribute after tax dollars. So this grows tax-free. Tax-free is great because you pay the tax upfront, but any gain that you've had of that compound interest, when you pull that out when you're 65, you don't pay taxes on that. That's your money. That's why Roths are a great investing tool. Okay, so then you contribute that one up to $20,500 a year for employee-sponsored retirement plans. If your employer does offer this, again, look to see what the match is. That is free money. There's no income limit on employer-sponsored Roth 401ks, but you cannot open these yourself. Okay, now we're going into individual retirement accounts. What's great with these? You can open these yourself. So you can contribute up to $6,500 a year total between both accounts. Traditional IRA, circling back, very similar to traditional 401ks. You contribute pre-tax dollars. The tax benefit occurs when you contribute. So again, straight from your paycheck, you don't pay any taxes on that. It goes straight into your traditional IRA. It's tax deductible for some, depending on what your income is. Single, less than 73,000. Married joint, less than 116,000. Again, there's no income limit. Everyone can contribute to a traditional IRA. Roth IRAs, going back to Roth 401ks, you contribute after tax dollars. This grows tax-free. You are making money off of this. It's your money. You are not paying any taxes on the growth that you make from Roth IRAs. It does have an income limit. Singles, less than 138,000, and married, less than 218,000. However, don't feel discouraged by these income limits because there is a backdoor Roth conversion that you can do that you can still get your money into a Roth. Okay. 529 plans. These are a great way to make paying for your kids' college cheaper, especially if you start now. It's basically a Roth account, but you can use it at any age to pay for education expenses. So the goal is you invest in education. You invest into education and accompanying expenses for schools. So private schools like elementary, middle school, high school, and college education. This account grows tax-free, similar like a Roth. Money that you use for qualified education expenses as it's pulled out is tax-free. The great thing about this too is you can pay for room and board, or even if you're living off campus, these types of accounts can pay for your apartment that you live in near your campus. You can transfer all, or the nice thing as well, you can transfer all or part of the funds to someone else. So let's say first child, you contributed all this money to their 529 plan. They decide, you know, trades are for me. I don't want to go to college. That's great. Go into the trades. However, you can transfer that money into another child's account. So, or even a nephew, grandkid, if you have only one child, no problem. You can transfer into another kid's account. And as you being the account owner, you retain control over this account.
Hey, Amanda, we have a question in the
Yeah.
chat. The question is, do you combine Roth IRAs when you get married or keep them separate?
So you keep them separate. You can, the thing with Roth is it's more of an individual account. So you should each have your own accounts, but you can have a beneficiary being your husband or being your husband, wife, spouse. And then if anything were to happen, it goes directly to them. So just keep track of your beneficiaries. It's also super important with retirement accounts. If anything were to happen, keep an update on your beneficiaries. You always want to have that second person to go to. You can go on to reach out to HR, go onto your sites, throw a beneficiary in there, brother, sister, whoever it may be.
I have a related question to IRAs and 401ks before you continue on with the 529 or beyond.
Let's do it.
When you change employers, so
Yes.
I will use myself as an example because I have been very bad and procrastinating on this one. So my previous employer, I had a 401k set up with, and now I have the equivalent over here at Carroll, which is different because it's a nonprofit, but I know that those can be combined. Can you talk at all about that process of how I get the money from my previous employer's 401k setup into my current account?
So the nice thing, so there's two different options that you can do with 401k rollovers. One being you can roll that directly into your new employer's account. So that can include, you go, let's say Fidelity. Fidelity is your company's brokerage account. You go into Fidelity, you'll see your account. So worked at Ernst & Young, I just recently transferred it over. So you go into there and you start the process of rolling it over into an account. But actually, there's another option that you can do is you can roll it into your own individual IRA account. So that's personally what I did. So I can personally manage my 401k that I rolled over, but you can also roll it into your company's plan. So depends on what you want to do, how active you want to be within your retirement, but that's always an option. Okay. Lastly, last two accounts that I'm going over. I know there's a lot, so I'm glad I'm having questions coming in. These truly are the basics, so it's great that I'm having questions. Having an active role in your financial plan is honestly the best thing you can do for yourself. So we're going to go over two more. So an HSA, that's a health savings account. See if your employer offers HSAs. Otherwise, you can also open this yourself. HSAs can, as you contribute, this grows tax-free. Health savings accounts, you get to use the money that you put into your health savings account and pay your medical expenses without paying taxes. So that's the huge benefit of that. It pays off your medical expenses. You don't pay that taxes on it. So paying medical expenses are awful in itself. So paying tax on those expenses makes it hurt even more. So if you can avoid those costs, that's a huge ticket item. And if these grow and you continue to grow and you have an amount left over, when you're 65, you can keep them in there. As you get older, healthcare gets more expensive. Or if it's a large amount, you can withdraw those at age 65 with no penalties for anything it may be. Contribution maximums, if you're single, $3,850 a year, and if you're married, $7,750 a year. Taxable brokerage accounts, last one I'm going to go over. This is a standard investment account, an individual account, some people may call them as. These are a great alternative for different savings plans. Let's say 10 years down the road, you want to build a house. You can work it a bit differently to invest a bit, see where you're at in 10 years. You can pull that money out. Unlike Roth, it's a bit more with retirement, same thing with 401ks. And then again, this can be more of a short-term investment strategy or a long-term investment strategy. Okay. Any questions at this point? I know we covered a couple questions, but as we were going, did anything else pop up?
I have a question, and maybe this is kind of silly. So when my husband and I were doing our taxes, I thought it was weird that maybe there was supposed to be a spot for it, but I felt it was like weird that there was no tax documents available for any of my like investments with that I have like with Fidelity or with Transamerica, that like that's our the company that manages our IRA with Carol. So I just thought that was kind of weird. Why would that be?
So if it's like a 401k, you won't necessarily get a actual tax document. If you have it through Fidelity, they are called 5498, and it's a statement. It's kind of like a fair market value of where your account is at the end of the year. You don't need to report these on your actual tax returns because, again, you're not pulling that money out yet. So you don't need to pay taxes on it. If it's delayed, like 401ks, you pay taxes as you pull it out. Roths, you pay taxes beforehand. So when you pull it out, when you're 65, you don't pay any taxes on it. It just counts as you pulling it out, but you already paid it, so you're good to go.
Gotcha. I think when tax season comes around, I automatically panic. I'm like, okay, where's all my money and how do I account for it? You know?
It's a common misconception. I mean, it's great to look at your statements every month and kind of see how your money is coming in, how it's flowing. But yeah, don't need to worry about that for taxes unless you pull money out. That's the only time you have to worry about it.
Noted. Thank you.
Yeah, not a silly question. Also, I have a bunch of clients who ask me where would they pull their forms, and it's questions for a large majority.
Good deal.
So now we're going to put any other questions before I go into the next section? Good?
Nothing in the chat. Yep, you're good.
So now we're going to go into putting your plan into action. Going over W4s, a simplified investing order of operations, why you should invest. And again, what I'm covering is extremely dense. I'm glad you guys are all here. Ask me questions, but again, this can be complex. So if you need some help, it's understandable. This is a hard type of financial planning, and taxes are kind of hard to break down sometimes, especially if you don't have that type of background. I went to school for accounting. So in my mind, I'm like, this comes more naturally to me, but it's not an easy thing to fully get your grasp on. Okay. W4s, you should look decently familiar if you've had a couple jobs. This is the form that you fill out when you first start a job. And this form you fill out based off of how much federal withholdings you want to have from your paycheck every other week, every month, so on. So you go through and you fill this with exemptions. So here's my tip. after you file your 2022 taxes, evaluate kind of where you landed. Did you owe or did you have a refund? If you owe, I would recommend reaching out to HR, out to someone that helps you, refill out your W-4 and make sure that you're withholding more money, because that can, depending on if you owe more than $1,000, you're gonna have to pay some penalties and interest on that if you don't pay enough in throughout the year. So keep an eye on that. If you have a big refund, it feels amazing. It's money you didn't expect to come in, but at the end of the day, that's your money. Your money has been sitting with the government for the last year as they make money on your money. But if you plan a little bit better, you can hold on to that money yourself, put into a Roth, put it into, if you're a little bit nervous about investing, put it into even a money market. Right now they're earning 4%. So earn money on your own money. Next thing that we're going to go over. This is just a basic investing order of operations, something to kind of follow by. Every person's situation is different, but here is kind of what I would recommend. First, I recommend putting your money into a 401k and or a Roth if they offer that, up to your employer match. Max that money out. That money is free money basically. So if you're not hitting that match, you're missing out on some free money. So highly recommend making that match. Emergency savings would be my next step. Things happen. People lose their jobs. Something breaks in the house. Putting money away every month into emergency savings is a cushion for you and something that then you don't need to stress on. Next, contribute to your employee-sponsored HSA plan. Paying taxes for something that's necessary is not ideal. So if you can contribute to an HSA plan, that would be my next step. Then if you have money left over, you're doing pretty well. Max out your Roth IRAs. Again, I'll be going over a slide. I think it's the next slide of how awesome Roths are, but max out those Roths. If you have any additional money left over, consider opening an individual brokerage account for short-term or long-term investments. Open up the 529 plan for your young babies. I just recently opened one for my little daughter, Mia. She is only 7 months old, but I intend for her to go to school. We'll see what happens. If not, I'll transfer it over to the next kid. Lastly, circle back and max out the remaining portion of your 401k. That's the $20,500. When you do that, you're reducing your taxable income, so you're getting taxed less for that year. So if you're reducing your taxable income, if you don't necessarily need that money, you're waiting until you're, let's say, 65 when you are in a lower bracket. So then you're paying less money on those taxes. Okay.
I have a question relevant to what you were just saying. So just to make sure that I'm following and everyone else as well. So the amount of your taxable income going way back to the first 1040 sheet, like the bottom number where you were pointing out, it's not just your income, it's the taxable income. That taxable income is after you put money into a 401k? Exactly.
So the money that you're putting into your 401k now, that's not getting taxed this year. So that's something to really think about. If you are kind of on that point where, if we go back to your brackets, let's say $44,000, if you're kind of teetering right there, consider putting a little bit more into your 401ks. Then you're not getting taxed at that next bracket, which would be the 22%. So a lot goes into planning, but that's something to consider. Okay, so now we're going to go over the importance of investing. Compound interest is extremely, extremely powerful. I'm going to give you a Roth example here. So let's say you max out your Roth each month. That's $540 every single month that you're putting away. You did that for 20 years. In 20 years, you will have contributed $130,000 into your Roth. But with compound interest earning 10% of that, after 20 years, your Roth is going to be worth $415,000. Of that, $285,000 of the difference, you don't pay taxes on it. You pull that money out, that's your money. Don't pay any taxes on it. So that's a huge benefit of Roth and a big benefit of compound interest of how fast it grows. Another example here, if we're taking a look at this chart, you can look at it a bit more detail. If you want the slides, I'll send those out. But the green line is someone who's a consistent saver, started saving young, they put it in their savings account, but they didn't invest. At the end of when they're 65, they're going to have $158,000. Pretty good. They saved a lot. However, if you are a consistent saver and an investor, and you started at the age of 25 to 65, you're going to have $512,000 in your account. So big difference. Consider investing.
Amanda, there's a question in the chat. Question is, I might have missed this, but how do you open a Roth 401k?
So Roth 401ks are employee sponsored. So if you'll have to look back at your benefits to see if your employee offers a Roth 401k, but there are individual Roth IRAs. So with those, you can go to Fidelity, open up account, and you can start that Roth IRA. You have to make sure that you actually select money to be going in and being invested, because when you put money in, it just goes into cash. So you gotta be aware of that. Otherwise your money's just sitting in cash. Again, if you're over that income limit, there's a bit more to it. So you're gonna wanna do a couple extra steps to that.
If I could add a tip too, because I've worked in Fidelity a little bit with my previous employer. It gets really confusing when you start trying to figure out stuff on your own. So try to find someone who knows what they're doing with Fidelity. So I highly recommend reaching out to a financial planner who knows how to open that kind of stuff up and move money around for you.
Yeah, it gets a little confusing. So feel free to reach out to me with questions if you guys are having a hard time. Okay. How are we feeling? Do you have questions? I feel like you guys are all doing well. I mean, hopefully you're getting some of these basics down. It's awesome that you guys are here and you want to have a big part in your financial plan. Well, okay. Again, I work for Vantage Financial, and from my experience here, these are just, if you decide that some of these concepts are a bit complicated to understand, here's some things that I would recommend if you're considering in partnering with a wealth advisor, financial advisor. So they will help you navigate real life situations and questions and help you execute that at each stage of life. It'll help you free up some time stressing about your financial plan so you can focus on executing it and actually saving. An experienced team will help you. We'll have the tools you need to be prepared for uncertainties. And then the right advisor should give you unbiased advice tailored to your situation. You shouldn't feel pressured by your advisor to do anything you don't want to invest into. Health insurance, life insurance. You should feel comfortable talking to your financial advisor. So that would be the best advice I could give. Any other questions, you guys?
I have kind of a weird one for you, but
Yeah.
it was very relevant in the last few years. I hear less about it nowadays, but digital currency, is that
Mhm.
something that you guys work with at all and in your practice, and or do you have any opinions on it at all? And if not, that's totally fine too. It's just something that I have thought about.
I personally don't have too many extreme opinions. My best advice is diversify when you can. If investing in the digital currency seems interesting to you, go for it. But ultimately, it's all about diversifying your accounts and having a plan that you feel more comfortable in.
Another question. Oh, sorry. What were
No,
you
go
gonna say?
ahead.
Okay. Another question in the chat. Is there a difference between a tax advisor and a financial advisor?
There is. So tax advisor is more gonna be like a tax preparer, a CPA. They're great. I used to do it myself. Pretty much they can help you in the moment when it comes time to filing. Financial advisor, they're gonna more so help you throughout the year, continue that plan. So right now I'm in kind of a blended role. I'm doing tax returns when it comes time and wealth advising. There's not a whole lot of advisors that do that, but typically they're two separate people. Okay, so some key takeaways, if you can take anything away from this, incrementally save. So important to incrementally save. Automatically take it out of your account every month. You won't feel it as much. It won't be as hard in the heart if you do it every month. Max out your contributions up to your employer match. Again, that's free money. Look at your plan 2 times a year, reevaluate your financial plan, see if you're on track to what you said you were going to do earlier that year, and make compound interest work for you instead of against you. I have my little QR code. Feel free to scan it. You can add me on LinkedIn. Here's my email. Feel free to reach out to me with any questions. I can also get you guys these slides if some of the concepts, like the differences between Roths, 401ks, so on, I can get those to you as well. But thank you so much for participating, and I really appreciate all of you attending this.
We did have another question pop in, if you're open to answering. How much of my income should I be investing where I still have enough to purchase maybe my first home? I don't know if that's supposed to be a question or.
Yeah, we can go back to this slide here if you want to take a screenshot of this. This is kind of what I would recommend investing into your retirement accounts. If you want to retire by the age of 65, live the same kind of lifestyle, I'd recommend kind of following a path. Oh, it went backwards. Sorry, guys. Okay. So again, current household income, your age, if you started saving now, I would recommend, like, if you are 25, just trying to save, if you are making 70K, investing 7% of your income. If you can't quite make that, just try to hit your employer match. That would be the biggest ticket item that I would recommend. If you can't quite, do this yet, you can do it later on, but hit your employer match if you can. And if you guys want to drop your email, that'd be great too. If you want to send that in the chat, I can reach out, send you these slides, if we don't already have your email.
Everybody is saying thank you. They're all very appreciative.
Thanks, you guys. I really appreciate it. And again, feel free to reach out to me with any questions. This is a passion of mine to help young professionals get their life started. So feel free to reach out.